All right. Hello and welcome, everybody. Thank you for joining us on today's webinar. We're going to be talking about a very, very interesting and impactful topic that a lot of people don't know about. Obviously, people have heard about tax planning, but a lot of people aren't familiar with the world of charitable trust. So we're going to be talking about tax planning's best kept secrets, and then we're also going to be specifically going into a significant amount of detail about charitable trusts. And of course, as usual, we have scoured the country to try to find an expert speaker on the topics that we're trying to educate you guys about. And in this particular case, we are very fortunate to have one of our most highly sought after presenters who really specializes in the area of tax planning and especially has a lot of experience in charitable trusts and donor advised funds, more than almost any other advisor that I've met. So I'm going to be introducing you in a second to Frank Oliver. But I also wanted to let you know, Frank is one of those guys, and we've worked with him for a number of years now, and he's headquartered in Fort Collins, Colorado. But he is one of those guys that really feels and believes in the cause and the foundation. And he does a lot of charitable work. In fact, he has sat on the board of his own Rotary Club in his local town. I think it was called the Twin Peaks Rotary. He has also been involved in fundraising in other charitable organizations. He was a participant in the Fireball Run, which was a national event that helps find missing children. He was also a treasurer on the board for Harley's Hope Foundation, and their mission is to ensure low-income parents or pet parents and their companions and service animals are able to do their best job helping people. He's also a lover of the outdoors. He runs a family practice, which we just are thrilled with his wife Brittany, and he's got almost 2 decades of experience in the stuff that we're going to be talking about today. So I'm going to go ahead and show you his picture, and again, not only my picture but his picture are both a little bit dated. I don't want to do a bait and switch in case anybody ever sees us walking down the street and says, "Hey, why don't you guys update your picture?" But anyway, Frank, are you there? Can you hear us?
I'm here. I'm here. Those are great pictures, by the way. Those are great pictures.
They do make us look pretty good. I'm not going to lie.
Do.
So,
yes.
So before I have Frank chime in, if you are not familiar with our organization, I am the director of the national headquarters in Washington, D.C., and Frank runs our Northern Colorado chapter. We are a 501c3 nonprofit. We are dedicated to bringing educational resources directly to the public. We have a couple of disclosures I want you guys to understand. We have a lot of experts in a lot of areas. Very, very seldom do we get a guy like Frank whose expertise spills into multiple areas, not only in the trust world, the tax planning world, but he also has licenses and expertise in individual investments and financial advising. However, we do not endorse any individual or corporation, and anything you hear today is strictly for educational purposes only. We are not affiliated with any group or organization either. So anything that you hear about today or any of our workshops should not be construed as any type of advice or recommendations, and we highly suggest that you seek out a professional such as Frank, who is licensed in the arena that you would like to get recommendations for before you take anybody's advice, especially in the areas of investments, insurance, tax, legal, real estate, and financial instruments. So with that being said, we're going to go ahead and talk and just jump right in the presentation because I know Frank is chomping at the bit to share his wisdom with us. But Frank, there's a lot of misconceptions out there about what tax strategies really are and why don't most people usually have a tax strategist on their team. And, you know, a lot of people tell us I've got somebody who does my taxes, or I might have a CPA. But
Right.
Why is it so seldom somebody comes in with an actual tax strategy and says, "Hey, Frank, would you review my tax strategy for me and tell me what you think?"
Well, I think it's a very big misconception when it comes to tax prep and tax planning. And most people, when they think about doing taxes, they're thinking about getting their taxes filed before April 15th. So they, don't miss that deadline, and, trying to determine what type of write-offs they had this year. Am I going to be, itemizing? Is it going to be a standardized deduction? But they never really look forward into the future to determine, boy, am I out of balance on my tax deferred funds versus my tax free funds versus my taxable funds? Where am I going to be at retirement when I go to extract those funds out of my accounts? Now I'm going to go from an accumulator to a spender. And those ideals, that paradigm shifts, very rapidly at retirement. And I don't think a lot of people looked at that far into the future. And I don't really think that, the accountants are focused on on getting your taxes handled today. And they're under the gun, and they have hundreds and hundreds of clients to work with between January and April 15th. And I just don't think it's in their wheelhouse to look forward. And I think that's something that we strive to do, is help people look into the future and determine where they're going to be, from a taxable standpoint, 10, 15, 20 years from now, as well as where they're at today.
So, everybody's looking for that immediate gratification, right? They're saying, well, how can I save money on taxes today? But oftentimes, the tax savings today comes at a cost, meaning potentially high taxes later. And I think that's sort of the message that we want to send to you. When people come to you and you give them advice on, setting up tax strategies, are exit strategies something that you find very important? I mean, do people come to you and say, Frank, I don't really know which accounts to take money out of. I don't know the order of which to take money out of. I don't know how to maximize my income from these things. Is that an important piece that I think people are missing?
Yeah, I think that's one of the most crucial pieces. We look at exit strategies and which accounts are going to be drawing income from. Maybe it's a combination of those accounts, a combination of a tax deferred account, which would be taxable when you take income, combining that with a tax-free account, or, any other different tax strategies in there to lower that marginal tax bracket as you're drawing, funds from those accounts in retirement. And I think in all too many cases, the individual retiree or investor will focus more on that pot of money, trying to grow it. If I can earn an extra 2 or 3%, that's really going to set me over the top. But they earn an extra 2 or 3%, and then they lose 30 of it in taxes because they didn't have the proper exit strategy or the tax planning set up.
Yeah, when you talk about the math that way, it makes a lot of sense. One of the things that we also want to talk about today that I think people will understand but don't often deal with is this idea of deferring does not mean saving, right? So if you defer your taxes for a later date, that doesn't mean you're saving taxes at all. And in fact, I asked an accountant one time, I said, why did you tell people to max their SEP IRAs if you don't know what taxes they're going to have to pay in retirement when they take the money out of their SEP IRAs? And he literally just gave me a blank look. Like, he didn't know how to answer the question. And so we've been programmed, Frank, our entire lives to defer, max this plan, max that plan. But how many of the people that you consult with have really done the homework and projections to know what is the likely tax bracket they're going to be in at retirement, and how's that going to affect their withdrawal strategy?
Yeah, that's an excellent question. Very few of the clients or prospective clients that we meet with have really looked into that math. And 75% plus of the country has 75% of their investments into tax deferred accounts, meaning 75% of that income for 75% of the country is going to be taxable at retirement. And so defer does not actually save you money in the future in many cases. And I would venture to say that over half of our clients are in an equal, if not higher, tax bracket at retirement than they were when they were working. Deductions have changed. They're not contributing to their 401k anymore, which really knocks a big chunk of that income off when it comes to tax time. They don't have that anymore. So pensions kick in, Social Security kicks in, required minimum distributions kick in, and before you know it, they're in just as high, if not a higher, tax bracket. At age 72, when required distributions kick in, as they were when they're working. And I think I see another big situation that people don't take into consideration is making like an unexpected purchase. What if somebody wanted to purchase a car and they have $500,000 in their IRA, and they decide, what, I have plenty of funds, I can go pay cash for this car. So they write a check for $50,000 out of their IRA. It puts them up into a higher tax bracket. It just cost them 24% in taxes to buy that car. So it's good to have tax diversification.
Yeah, tax diversification. I'm glad you brought that up because that is really, really important. So let's go and start with some basic things that I know the differences in all these accounts, but I'm surprised how many people don't really or haven't really had experience with, different types of tax diversification in different types of vehicles to really know how they can maximize, their options when they do need to pull money out. The first, which is the most obvious, which most people know about, isn't a tax deferred vehicle. It's actually a tax deductible vehicle. So when you talk about 401ks and IRAs, how do you define something, Frank, that falls under what they call the tax deductible drawer?
Well, I would define that as, you're receiving that tax deduction for the contributions going into that retirement account, but they are taxable. The day of reckoning will come when you have to pull money back out of that account, and then it is going to be taxable, and you don't know what the tax brackets, the marginal rates are going to be at that time. So, um,
The
so
day of
what we
reckoning, I like that.
yeah, the day of reckoning, exactly. And so what we do is we try to determine what tax bracket they're in currently, and if they are going to contribute to a tax deductible account, just contribute enough to pull yourself out of a high tax bracket. If you contribute enough that it pulls yourself down into a lower tax bracket, then maybe that's when you look at alternative tax diversification and contributing to a Roth IRA versus an IRA if you're, once you get into that lower tax, that marginal tax rate.
And then, so this next category that we have, and by the way, the first category, I would just let people know that the tax deductible things, which are like the retirement accounts, they don't have any basis. So because they have no basis when they draw it out, every single dollar is taxable. And I think people know this intuitively, but a lot of times, Frank, they haven't heard it actually said out loud, right?
That's right. No, you're
Here's a big
absolutely
one
right.
that, yeah. So here's a big one that shocks a lot of people: the taxable accounts. So
Right.
I know you've got a big history of helping people invest their money in non-retirement accounts. Once in a while, and I've seen this happen twice in my career, in 2000 and in 2008, we had clients that owned mutual funds back in those days, and the value of those mutual funds went down, meaning they lost money. But then the next year, they got a tax bill, and it actually generated a taxable event when they lost money, and they had no idea that was even possible. Can you explain briefly just how that happens and why that is possible?
Well, yeah, I mean, you're being taxed on those, on those, one on the dividends, and then two, you could definitely be taxed on the capital gains, before that market, crashes on us. So you're being taxed on the growth, paying taxes on that net asset value, or possibly the dividends as well. And then the market turns backwards on us, and you pay taxes on an account value that is worth 30% less today than it was once you paid the taxes on it.
That doesn't sound like a great idea. I mean, I feel like we should try to avoid that at all costs, right?
Oh, I agree. And, that's just where diversification comes in, and if somebody's in a spot where they have to pull money out of mutual funds in a pinch when the market's down, that just goes back to, maybe their planning wasn't, thought out as well as it should have been.
So under the taxable heading, I guess we want people to understand they pay taxes on the money every year. A lot of times, obviously, if it's CDs or dividends, they're making money, but there's no guarantee they're going to make money in the funds, but they pay taxes regardless. And then,
That's
of
right.
course, we have sort of the most common ones like the tax freeze, right? Most people think about tax freeze. They think, okay, I put money in and it grows tax free, and that sounds good. But those tax frees, especially in the Roth category, Frank, we like to call them triple tax free, right? They're not just tax free to you as they grow and defer, but then they're tax free as you take income out, and then whatever is left is also tax free to whoever you leave the money to. Some people don't even realize they qualify for Roths. Maybe they think they make too much money, but they can always convert, Frank, right? I mean, are there any stipulations or qualifications you need to be able to Roth convert your IRAs or retirement accounts?
Well, not as far as income is considered. So a lot of people have heard of the income threshold when it comes to a contribution to a Roth, and that in their mind will mentally create a roadblock for them ever doing a conversion because they believe, no, I earn too much to do a Roth IRA. Well, that's not true. You're correct in the fact that they can convert at any income level, any dollar amount that they choose. There's a 5-year window that you got to watch out for before you can start withdrawing the funds. But as long as you're, have a time horizon that makes that acceptable, then that shouldn't be an issue at all. But one of the things that we explain to our clients, like you had just mentioned, John, was that the not only does it grow tax free, but the income is tax free, but the wealth transfer forever is tax free. So, I look at a Roth conversion as a 2 life events. And it could very easily be a 3 life events. So it's not just for your life, but it's, for the life of your family too. When those funds transfer over, there's, no taxes on that transfer.
And if we could show somebody like a compound interest growth chart of being able to do multi-generational tax-free planning, I'm sure the numbers would be unbelievable, right?
Oh, it's ridiculous. It's so much stronger than on a tax tax deferred account that you pay taxes when that wealth transfers to your heirs.
And of course, there's municipal bonds that are tax-free. Different types of insurance are also tax-free.
Right.
The area that I think a lot of people don't know about and don't know how to use to leverage their other accounts are under what we call the tax-deferred column. Most people think tax-deferreds are 401ks, but they're not, because a tax-deferred account has a basis. Can you explain to people briefly what that means?
Yeah, so the tax deferred account would be a non-qualified tax deferred account, which means that there is a basis on your initial investment and continuing contributions into that non-IRA or non-qualified tax deferred account. But the earnings on the growth of that account grow tax deferred, meaning that you're not paying taxes on that growth on an annual basis. And you will end up paying some taxes on those earnings once you start to draw that back out in income, but you can control what you pull back out in income. So you're not taking the entire lump sum up front, paying taxes on $100,000 worth of growth. You're just spending it very sparingly as needed, controlling that tax bracket. So if you're in a position in your working years where you're in a high tax bracket, a lot of times a non-qualified tax deferred account makes really good sense because you're not paying taxes on that growth on an annual basis like you are in some other investments.
So it sounds so simple, Frank, when you describe it. For everybody else, it's really important that you do consult with somebody that understands the differences of these 4 different types of taxable vehicles, understands the diversification necessary to really maximize your plan and utilize, all 4 of these different types of plans. I'm going to go ahead and jump forward and just I don't want to spend a ton of time on the marginal tax rates today, because there's so many other good things. I'm excited for you to share the tax strategies with everybody. But don't you think it's important for most people to know what tax bracket they're in, like right now? Because most people don't even know that.
Oh my gosh, it's paramount. It's paramount. And you're right, most people do not understand what tax bracket they're in right now.
So what Frank was saying earlier, let's just take, for example, I don't know if I can get my cursor here. Whoop, I can't. If you look at here, where under it says married filing jointly, a lot of people, Frank, maybe who don't really know or were never taught, they think, let's say somebody's making $200,000 a year as a couple under married filing jointly. They might think because they're in the 24% tax bracket that they pay 24% tax on all their money, but that's not how it works, is it?
No, that's not true at all. They're only paying 24% taxes on the income earned above the $171,050 to the $200,000. Where we focus a lot on is, go ahead.
No, please.
Yeah, what's interesting is what we focus a lot on is the 12% marginal rate, which is actually extremely low. But it's very interesting that if you look at the 10% rate to the 12% rate, that's a 2% jump. If you look at the 12 to 22, that's a 22% jump. Then the 22 to 24 goes back to a 2% jump. So most people are going to fall somewhere between that 12 and 22% after they take some standardized deductions, 401k contributions. And to be able to pull yourself from a 22% bracket down to a 12% bracket, that's a big savings when you're making contributions. I've just always thought it's very interesting that no matter what administration got into office, that was always the 10% jump right there at the middle class. So I just think that's something to be very cognitive of when you're making investment decisions and tax diversification decisions.
Yeah, and so all of these rates are going to be going up in the future, right? At least under the current plan, all of these marginal rates are set to increase.
Yeah, well, the current tax bill sunsets in 2025, and with the current stimulus package that's Congress has implemented for us, there's going to be a big tax bill to pay or a big debt to pay, and undoubtedly in 2025 when that bill sunsets, they're going to make a change, and I don't think it's going to be favorable for us.
No, I think most people would agree that they're going to be battening down the hatches for some increasing taxation coming up in the future.
Yep, they have to.
Obviously, for this tax strategy to work out well, we can start to identify, where we are today. That's how we begin a tax strategy. And then we got to talk about how to do the tax harvesting and the Roth conversion. So I'd like to kind of move forward on that. But let's say, for example, somebody does make $200,000 as a couple. Maybe each spouse makes $100,000, and they're in this 24% bracket. They can make a lot more and still stay in the same bracket. And if these brackets are definitely going up in the future, now we're talking about, how to maximize the bracket that they're in potentially. I've got the U.S. debt clock right now pulled up on my laptop, and the national debt right now is sitting at $25 trillion. And it says right here that the total interest paid on our national debt is about $3 trillion, and the total federal tax revenue is $3.2 trillion. So the total interest due on the debt is $3.7 trillion, and the total federal tax revenue is $3.2 trillion. So we're at a deficit. So a lot of people don't realize the difference between debt and deficit. So we're in a deficit in the trillions of dollars each year. Plus, we have this massive national debt. And if you guys have never looked at this website before, it's called usdebtclock.org. We've pulled it up in other workshops. I can't get it to coordinate with the software, but check out usdebtclock.org. And it's really awesome. It shows you the population. It shows you the Federal Reserve, national debt, deficit, all this kind of stuff, income tax revenue. But, you've probably had these conversations pretty much all day, every day, during recent times at least, where people just really expect taxes to get worse. And if taxes are going to get worse, what are some of the primary strategies that people should start thinking about now?
Well, I think taxes are undoubtedly going to be higher in the future. And with that being said, this was probably one of the best opportunities we've seen to take advantage of a lower marginal tax rate and perform what's known as a Roth conversion, where you essentially take funds from a 401k or an IRA or a SEP IRA and convert those funds into tax-free dollars for down the road in your future.
And the Roth conversion strategy, again, like you had said earlier, Frank, is anybody's eligible, right? As long as you have a retirement account that can be either in an IRA or moved into an IRA, then it is eligible to be Roth converted, correct?
Yeah, that's 100% correct.
So I've got some math. And again, this is math. Again, if you've seen our workshops before, we like to do the math just to explain the scenarios to everybody. This is the math that assumes tax rates don't change, right? This is the math that assumes the tax rates stay exactly the way they are right now. And the way that we like to explain it is, if you have a tax deductible account like an IRA or 401k, like we talked about before, if you have $100,000 in that account now, and it just grows over 10 years, and you earn 7% on it, that $100,000 will double to $200,000 bucks. But you haven't paid taxes on it, so we were just in this case just assuming a simple tax bracket that I could do the math in my head, Frank. This is for my own simplicity. Sure. I know the 25% tax bracket doesn't exist. But if you have a $200,000 IRA and you subtract the taxes out of it, your net after tax ends up being $150,000. But if you have $100,000 and you end up converting that $100,000 to a Roth, and you are in that same tax bracket, and you have to pay 25% tax on it now, you would pay the tax on it now. You would have $75,000 growing for the same 10-year period of time at 7%. And you would be left with net after tax the same $150,000 bucks. Right. So if everything stays the same, it's a wash, Frank, right?
Oh, absolutely.
But we don't think things are going to stay the same. And there's another factor here, which is government control. Which one of these accounts has less government control and more client control?
Yeah, well, definitely the tax deferred account has more government control, and the tax free account is going to give the owner much more control. We talk about that on a regular basis at our firm. We call it tax insurance. Not that everybody likes the term insurance, but being able to pay those taxes today and put yourself in control of your destiny tax-wise in the future makes a lot of sense. You don't know what's going to happen in the future. You don't know what your expenses are going to be, what your marginal tax bracket's going to be, what your emergency needs are going to be. And every dollar you extract from a tax deferred account is running the risk of putting you into an extremely high tax bracket. And when you convert those dollars into tax-free dollars, those worries, those fears, those concerns, and losing control of the taxes, that is all gone when you convert.
And so if we go back to the previous slide for a second here, I don't know if I can or not. Whoop. Yeah, I can. So this previous slide that we're looking at, we said, let's say a couple makes $200,000, right? And they're in this 24% bracket. They could easily convert $100,000 and still stay in that same 24% bracket. And just from my experience, Frank, I'll just let you guys know, my first year out of college, I remember this vividly. I made $28,000 a year in the early '90s, my first year out of college. Back then, my federal tax bracket was 28%.
Isn't that crazy?
So it is crazy. And in fact, Frank, you hear this all the time, and I tell people this all the time. Would you have ever thought when you were getting out of school or getting out of grad school or starting your first job that you were going to be able to retire and make $80,000 a year or $100,000 a year, sometimes $200,000 or $300,000 a year? It's sort of an unbelievable number to a lot of people, right?
Sure, absolutely.
So in this case, why, if it's a neutral decision, why do we really want to encourage people to really strongly consider doing more Roth conversions? And forget about, I know you're going to show people as we get to the end of this presentation, you're going to show them how to not have to pay the conversion tax or at least save the money or mitigate some of that. But why should we try to encourage people to do this if it's a neutral decision?
Well, again, I fully believe that it gives you much more control of your financial future, much more control over future taxes that you're going to have to pay, much more control over how much discretionary income you can pull out of your accounts without, running the risk of putting yourself into a higher tax bracket. You really have, again, just a much greater level of control over everything financially if your assets are in a tax-free area. And people, we run across this on a regular basis at our firm. We have some very successful clients, but they don't understand taxes. They had a nice 401k plan. They had a huge match. They got a pension. They just saved well. They didn't spend a lot of money. And, they retire one day. They wake up and they're successful millionaires at retirement and really sometimes have really no idea how they arrived at that position. But again, the majority of those funds are in a taxable position. And we had some clients up the hill here up in Estes Park, Colorado, and 2 college professors, 2 pensions, 2 Social Security benefits, and well over $2 million in retirement assets. And again, probably 80 to 90% of them were in tax deferred accounts or tax deductible accounts. And they came to the office one day and they pulled up in a brand new Subaru, and they were very proud. They took me outside to show me the Subaru, and I was like, boy, that's a beautiful car. And they're like, yep, we just paid cash for it. I'm like, wow, well, I understand where all your funds are because you share everything with me, and you didn't. I'm not noticing. Do we need to make some changes? I'm not noticing any money come out of your accounts to satisfy the 50,000. And they shared with me that they had an advisor that was a friend of their father's years and years ago, and they just had a little bit of money left there, and it was an IRA, and so they just took 50,000 out of that IRA to buy that Subaru. Well, they were already in a 22% tax bracket. So that put them in a 24% tax bracket. So you can kind of do the math. It cost them 24% in income tax to buy that car because all of their funds were in that tax deferred or tax deductible vehicle, no tax-free funds whatsoever.
And that's where the diversification really comes in. We're not saying people should all be in tax-free and pay taxes and everything now, but wouldn't it be nice if we could offer people a choice? Say, hey,
sure,
if taxes are high, take the money out of the Roth stuff. If taxes are low, take the money out of your deferred accounts. And most people really want to have and be able to benefit from that choice. The other thing that really struck me, you said multi-generational, maybe your kids, maybe your grandkids. Once you put them in the Roth, right, they're no longer subject to RMDs, are they?
No, they're not. That's absolutely right.
So for the estate planning, again, it's that same kind of paradigm shift. If you don't think you're going to spend your money, and I think judging from what you're telling us about your clientele, Frank, if they're successful, which most of them are, they're probably going to leave money behind, right?
Oh, absolutely.
So the money they leave behind, would they prefer to leave it behind in a taxable 401k or IRA, or would they rather leave it behind in a tax-free Roth?
Well, and that's a conversation we have on many cases. And once you explain that to somebody, then the light comes on and they realize that I can either leave the funds taxable or leave the funds tax free. And obviously by leaving the funds tax free, the family could receive 20, 30, 35% more in assets versus leaving them taxable. And a lot of times their children or their beneficiaries are big earners, and you stack, 2, 3, 4, 500,000, $1 million in taxable assets on top of the beneficiary's existing income. I mean, in the future, that could push them up to a 50% tax bracket. We have no idea what they're going to do with taxes. And you could lose half of that inheritance just in income taxes by not, looking into some tax-free strategies.
Yeah, and I'm glad you mentioned just in income taxes because that's not the only tax people might have to pay, right? A lot of people are focused on inheritance taxes. A lot of people
Right?
are focused on death taxes, maybe even federal estate taxes. But these are all in addition to income taxes, right?
That's correct. That's absolutely correct.
So as we're talking about these estate planning myths, I would say it lines up very similarly with what we're talking about with this defer idea. You know, you might have been taught to defer. You might have been taught you're going to be in a lower tax bracket when you retire. But if you do that math and the projections correctly, and you find that's not the case, we need to start thinking about, do we really want our kids to be saddled with all this extra tax burden? Was that our intention to save so much just so our kids could have to pay more taxes later on? Or are there other things that we can do to not have that happen? So we're going to go right into the tax strategies now. I know a lot of people have been waiting for this part of it, which is really exciting to me because I believe it is our responsibility, and I really love doing it. And you can tell that I like doing it. I want everybody on this webinar to learn the tax strategies of the wealthy, but I don't want them to have to pay for it. So you are one of the very few advisors that has well-versed in charitable trust and real estate LLCs and donor advised funds and all these different things. And I'm asking you this off the cuff, Frank, why is it that most people don't know how to implement all these incredibly powerful strategies?
I ask myself that question on a regular basis, and they're just not. I know it boggles me because they're just not discussed. They're not discussed by their financial professionals, their accountants, their estate planning attorneys. And these tools have been around for decades. These are IRS approved tools that have been around for decades upon decades upon decades, and they're just not discussed. I'm baffled as well, to be quite honest, because they're very strong tax tools that should be used by many people out there.
So we know that most people have the same problem, whether you're very wealthy or you're just middle of the road every day, or you just, living on the Social Security, nothing else. Most people have similar issues. The clients that we typically run into, they've been trying to do the right things their whole lives. It's not for lack of intent. It's just maybe lack of education. So, they've been trying to save money, but when it comes to their, distribution strategies, their estate plans, their exits, they just don't have any plans. Maybe they think it's too expensive to talk to somebody to develop this plan. Maybe they think that they don't want to, they're embarrassed because of how little they know. What types of experience do you have, Frank, with the types of situations when people come into your office and they say to you, Frank, I don't know how I'm doing, but I've got $1 million or $2 million. I feel like I'm doing pretty well. What are some of those problems that you identify with them on the back end of, how to get out of some of these accounts?
Well, again, just taxes, taxes, taxes. So we have, 3 or 4 different pieces of technology that we marry together. And I really think that does an outstanding job of quantifying, your answer. So you can make sure that you give a very accurate answer. And so we have the ability to look at, their pensions, their Social Security, and what tax diversification they have with all of their different accounts, whether it's all tax deferred or there's a blend of tax deferred, tax deductible, taxable, and tax free, and make that determination of where their income is going to come in the future. And we can look forward and determine, okay, here's what you need for expenses. Here's what your Social Security benefits are. Here's what your little pension is. And here's what you're going to have to pull out of your retirement assets. And where's that going to put you in a marginal tax bracket down the road? And we can also determine based on a hypothetical rate of return and, a little bit of inflation on their expenses, how much they'll need to draw from those accounts, what their accounts will be worth. We can determine what their required distributions are going to be, which is now starting at age 72, and determine, how much of that required distribution is actually needed, if any, and what that's going to, what kind of tax position that's going to put them in the future. The majority of my clients are not in need of their required distribution. They're forced to take it. They're forced to be put in a higher tax bracket, and they're forced to pay taxes on income that they don't need to spend. So we really try to.
That's not a great feeling when the government dictates your retirement, right?
No, that's right. That's right. Absolutely.
So today we're going to focus on one particular strategy that I believe is probably one of the most powerful. There's a lot of different ones out there. I don't want people to think this is the end all be all, but this particular strategy that I'm about to introduce you to, that Frank will discuss with you guys, it is one of those strategies that if you try to do it on your own, you have to hire a fiduciary, you have to hire a trustee, you have to hire an attorney. If you don't already have an accountant, you might have to hire an accountant, and you may even have to hire somebody else to sort of tie the strategy together for you. Most people don't want to hire 4 or 5 people. Most people don't know how to engage these types of things. So we're going to show you guys how to do this on your own. And then we're going to show you how beneficial this potential thing could be to your family. One of the reasons why when you go onto the internet and you research these topics, you'll find a ton of content, really good articles. There's some really, really good videos that we can recommend that you guys watch for educational purposes, but there's no step-by-step how-to guide on the internet for this particular strategy. Frank, why do you think that is?
Oh, I really think they're very complex. I mean, we've had great success at establishing these for other clients, but I think they're complex for the average consumer to get their arms around. And so I just think it's a neglected area.
So the type of trust that we're introducing you guys today is something called a charitable remainder trust. And under the charitable heading, you'd heard Frank mention donor advised funds. There's also things called charitable lead trust. There's NIMCRUTs, which are net income makeup trust. There's charitable remainder trust, charitable remainder unit trust. There's annuity trusts. I just want to focus on one today because I think this is sort of the most flexible. And we're going to tell you guys and teach you guys how you can actually set this type of stuff up directly on your own. So you can cut through a lot of the expense and the confusion, and we can do it for you. We can hold your hand, or somebody like Frank can just basically guide you as much as you want help to do this. But the most important part of this particular strategy is it creates a tax benefit, right? So it creates an immediate tax benefit for somebody, and that tax benefit can be used to convert Roth IRAs or to get more money into tax sheltered right now. I've got this sort of rudimentary cartoon-like graphic that I just wanted to share with you guys. And so in this particular case, let's say you have an individual or a client, Frank, that has an asset and they want to put it into the charitable trust, or they want to move an asset into this type of vehicle. What are some of the main 1 or 2 benefits that the trust spits back out to this client almost immediately?
Well, on a highly appreciated asset, the trust is going to eliminate all capital gains taxes on the sale of that asset. That's probably the most immediate benefit.
Do you mind telling people what a highly appreciated asset could include?
Yeah, a highly appreciated asset would be, several different things. Income properties are a really good fit for these type of charitable trusts. Highly appreciated non-qualified stocks, mutual funds. Those all of those assets would qualify as long as you have a low basis and a fairly significant gain, and you're worried about paying capital gains taxes to get out of that asset. A charitable trust, any version of these charitable trusts, will 100% eliminates all of your capital gains taxes up front.
So that by itself, Frank, I mean, that one thing by itself sounds like a pretty huge deal. You got gain on your portfolio, you've got gain on your real estate. Normally, if you sold it on your own, you'd have to pay taxes, but if you allow the trust to sell it for you, you avoid that capital gains tax event.
That's huge. Yeah. In addition to the tax deduction that you get by, establishing this trust. So there's an additional tax savings in addition to the elimination of capital gains tax. So the benefits honestly can just go on and on.
Yeah. So would you mind just explaining briefly what that charitable deduction means? What does that mean?
Yeah, well, I got a story of a client here in town. Maybe this would be a good way to explain it. So he had
Sure.
He had a single position of AT&T stock for about $250,000, and his cost basis, or what he invested into that stock years and years ago, totaled to be about $50,000. So for him to sell that one stock in AT&T, there was $200,000 in capital gains on that stock. And so he knew that that position was incredibly strong. He should not have had $250,000 in one stock. He was worried about that. but he also didn't want to end up paying, $40,000, $50,000 in capital gains tax to sell that one stock. So we repositioned that stock for him into a charitable position. And he was able to sell that stock and eliminate all of the capital gains taxes. And then based on his marginal tax rate, he also received a sizable tax deduction on that as well that offset some of his income that year.
Do you remember, like, of the $250,000 that went into that charitable trust, do you remember what type of tax deduction he got?
Oh, I don't, but I think with the elimination of the capital gains tax and the tax deduction, it would have, 60, 70, $75,000 all in.
67 to the good. Yeah, that's pretty great. And then there's the third feature of the charitable remainder trusts, right, which is that income. And
Right.
a lot of people don't realize, this charitable trust, you get to maintain control of the asset, you get to invest the money, and you get the income for the rest of your life. I think that's a piece that most people don't realize.
No, and that's huge. So you're able to pretty much replicate income that another asset was going to produce, but you're actually increasing that income because you have been able to sell that asset and recognize a huge amount of tax savings, increasing the value of that asset because you didn't have to pay taxes on it when you sold it, enabling that asset to actually produce more income and produce it for life.
So the three main benefits here we're talking about is avoidance of the capital gains tax. We're talking about a tax deduction on top of the avoidance of capital gains tax.
Correct.
And the third that we're talking about is an income stream for life. So that sounds pretty cherry in my book. What are some of the downsides, Frank?
Oh, the downsides are that you do have to pay a little bit of income tax on the income coming out of the charitable trust, whichever one that you decide to use. That would be one downside. I think another downside that there's a really strong go around on is if you do the lifetime income, that depending on how it's established, your non-spouse heirs might not receive any of that income if you were to pass away before the funds were utilized. But there's some really nice strategies for that as well.
Yeah, so the downsides, it sounds to me like, aren't too tremendous. And if you wanted to do more strategizing, like if it became more important for you to try to pass more money on what you call the non-spouse heirs, which would be your kids or other family members or next of kin, we could certainly accommodate to leave more money to more people if that was somebody's goal, right?
That's correct.
All right, so now, with this charitable trust, just as a sort of summary, you can get current tax savings, you can get current income, you can pass your wealth tax-free through Roth conversions and or through the trust, process to your family. Those are all things that sound really great. But the real win-win scenario for us is that this really is taking some of your money out of government control. So, just like the Roth and just like other tax sheltered things like insurance and other plans, these charitable trusts, the government doesn't typically have any access to changing the rules on these trusts, right? This is what we call an irrevocable trust, Frank, right?
Yeah, that's correct.
So in the irrevocable realm,
once that's established, they cannot change the tax rules on you. So it does make for a very strong and safe tax strategy.
And so what I wanted to kind of scroll back and show people is what type of assets could be suitable to go into this type of charitable trust tax saving strategy. Let me just go back for a second. We talked about all of these different types of vehicles, right? So taxable CDs, savings, dividends, mutual funds, stocks, those could all go in if you wanted to. You mentioned real estate, which is not on this list. That's a huge, huge benefit. I mean, gosh, how many of our clients do a great job investing in real estate over their lifetimes, but all of a sudden have all these gains at the end of their life and they don't know what to do?
And you can't sell a part of a house. So if you're going to sell the house, you have to pay capital gains on the whole thing. You can't just sell the front door,
Yeah, that's a good point. Tax deferred accounts you can throw into a charitable trust, like non-qualified annuities, non-deductible IRAs, modified endowment contracts, like we already talked about, other things like stocks.
Yes.
So there's a lot of different things, even cash, right? My gosh, do you know roughly off the top of your head, Frank, how much income these charitable trusts are required to spit out to the donors?
Well, the average is around 5%, but 10% on the upper end. So 5 to 10% is what they're required to take, depending on how you structure that and follow the formulas set forth by the IRS.
So that's unbelievable, Frank. So what you're telling me is, and I've seen this before, it startles me when I see it, but you're telling me you could have, let's say, a $200,000 CD, and that CD might only be earning you 1 or 2% right now. And
Right.
you could throw it into one of these charitable trusts, and then people could get an income stream of somewhere between 5 to 10% from that, in addition to the tax deduction of going in there.
Yeah, that's correct.
So again, I think the moral of this story is a lot of people don't know about these strategies because they just don't know what they don't know, and they normally wouldn't have access to this type of education. Frankly, frankly, because attorneys and trustees and people that want to teach this stuff, they want people with big money, right? I mean, they want to be able to charge you 20, 30, 40, $50,000 to help you do this type of stuff, right? I mean, how much
Right.
do people typically suggest you have to get this strategy started?
Oh, millions and millions and millions of dollars, which I think you could perform these strategies with significantly less. A tax benefit is a tax benefit.
Yeah, that's a great way to put it. So we believe that if this tax strategy is really useful for wealthy people, why on earth would it not be useful for everyday people if we could eliminate the fees, right? That's the whole deal.
Right.
So that's sort of what our goal was today, is to try to introduce you guys to some of these tax planning strategies that aren't readily known or available, and to teach you the availability of these for virtually no cost. Most people would have to engage a number of different people, Frank, but through our nonprofit, this is just part of the education that we sort of uh, give out to all of our clients, right?
Oh, absolutely. Yeah, it's a wonderful nonprofit organization, and all the tools that are available for retirees are right there.
So this, again, is just sort of an intro to a really powerful but important strategy. There's other things that people can do. We talked about Roth conversions today. We talked about charitable trusts today. It is almost impossible for people to be able to implement this on their own. We don't want people to think they have to. We exist really to hold their hands in this process. If you guys want to learn more about it, I strongly urge you guys to not only attend more of our webinars, but talk to somebody like Frank, because he's not just going to talk to you or educate you about one program, generically speaking. He's going to look at your situation. And we always say that, a great idea is a great idea, but the implementation of the great idea is where the value comes from. So a lot of people can talk and say things and come up with strategies, but very, very few people know how to implement. And of course, you're taking time out of your day today to talk to us about this, Frank, but you're implementing all day long, every day. I mean, that's what you do, right?
Oh, absolutely. Yeah, we've implemented several of these strategies with great success. So that's what we do day in and day out is retirement planning, tax planning, investment planning, social security planning. Absolutely.
And in the world that you work in, a lot of times people may be getting advice from multiple people, but personally, Frank, are you okay with helping them even if they already have somebody else they're working with in another arena, and just helping them coordinate maybe more of a macro, more of a holistic big picture strategy, because they may be missing out on some of these other things that you do have experience with?
Oh, absolutely. Yeah, I mean that's what the business is all about is showing people strategies to save them money on taxes, preserve their assets, and produce income.
And so in this particular case, we also want the client or the consumer to know that they don't have to give up control of their assets. So a lot of times people are afraid to do certain things because they think they won't have access to them, or they got to give their money to the American Heart Association or to the church or somewhere. We definitely want to be able to tie in charitable strategies with giving and with tax benefits with income, but control and access are paramount for us, and that's something that we really want to key in on and stress in this conversation today. So just because you have an investment advisor, or just because you have an accountant, or just because you have somebody else that's giving you advice on your insurance or wherever, doesn't mean that they are educated and know how to coordinate all these different strategies together. And when our foundation goes out, I mean, it was a long multi-month process, sometimes years, vetting and getting to know people like Frank and his practice, his family practice in Colorado, making sure that they're well-versed, educated, and not just showing people and talking to people about what's out there, but the actual step-by-step implementation. Frank can do everything from individual investments to helping you with tax saving strategies to insurance planning, estate planning, or whatever. In fact, our organization does a lot of the CE, continuing education credits, for accountants and CPAs across the country. So, the vetting process for us is vitally important. And, Frank, I just wanted to, again, thank you for being here. I know the time really flies by on these types of things, doesn't it?
No, it does. No, and thank you very much.
Do you have any other closing thoughts or remarks or comments that you would like to share with our webinar attendees today before I sign off with them?
No, just that I think it's important for everybody to look into the options that are available for them. And just because it's, a little bit out of the mainstream, thinking a little bit out of the box, these strategies have been around for decades. They're IRS approved, and it doesn't hurt to look at them. It doesn't cost anything to look at and evaluate these strategies. And it could save you a fortune on taxes, and it really could open up some nice doors for you. We hold CE classes ourselves for accountants, CPAs. We have some enrolled agents in as well, explaining these strategies to them because they're not well versed on that as we are. So it doesn't hurt to look. It's you may learn something that'll benefit you and your family for generations to come.
And just a little plug for Frank, just so you guys know. I mean, I've known Frank for years now, and he's one of those guys that whether you have a couple $1 million with him or a couple 100,000 with him, he really believes in helping people, treating everybody the same. And I think he's doing such a great job out there. And hopefully, if we can entice him, if you guys give us good feedback, and we can entice Frank to join us on some additional topics in the future and share or lend some of his experience and expertise in other areas, I think we would very much appreciate that. So everybody's going to get a survey after this webinar. Please take an opportunity to fill that survey out. Two really important things that we need to do through our foundation. We need to educate people, but we also need to know what resources that they would like to see in the future. So by filling out the survey, you will be invited to future webinars like this one if you are not already on there. In addition, you can reach out and ask for some individual counseling if you would like to talk to Frank or somebody like Frank. All of that is available through our foundation. There won't be any types of consultation fees or planning fees, and you don't have to worry about the other shoe going to drop. And I think we're going to be looking forward to spending more time educating you on different areas. So please fill out the survey, give us feedback, let us know what you liked or didn't like, what you'd like to hear about in the future. Reach out for a one-on-one consultation, and just please use us as a resource. Frank, once again, thanks for being with us today. Everybody else out there, please stay safe, and we look forward to continuing our relationships with everybody. Have a great day, everybody. Thanks, Frank.
Thank you.